Your Social Security raise for next year is projected at 3.6%. That is about $75 more a month. But 4 separate rules are already lined up to take pieces of it back before it ever reaches your bank account. By the end of this video, you will know exactly what each one costs and what actually lands in your check in January. If you appreciate this type of content, gently tap that like button. Let us get into it. Here are the numbers that decide everything. Alright, first let us talk about the raise itself. Every year, Social Security adjusts benefits for inflation. It is called the cost of living adjustment, and it is calculated from consumer prices in July, August, and September. The Senior Citizens League currently projects 3.6% for next year. That is well above the current 2.8%, and it would be the largest increase in 4 years. The official number arrives October 14th. So what does 3.6% actually mean in dollars? For the average retired worker, it adds about $75 a month, bringing the average benefit to roughly $2,159. But that is the average. Your own increase depends on your own benefit because the percentage applies to what you already receive. A larger check gets a larger raise. Now the first thing waiting to take a piece: Medicare. Part B is deducted straight out of your Social Security payment before you ever see it. This year, it is $202.90 a month. Next year, it is projected to climb about 3.5% to roughly $209.50. That is $6.60 a month, taken from the very same raise, automatically, with no action required from you. Here is why that matters more than the amount itself. Because Part B comes out first, you never actually see the full raise. Your deposit shows the net number, so most people simply assume that is what the increase was. $6.60 sounds small, but it is nearly 9% of a $75 raise, gone before the money arrives. And it is only the first of 4. Next up is the one that hits your prescriptions. For the past 2 years, Medicare has been paying drug plans extra to keep premiums from spiking. That help ends December 31st and will not be renewed. This year, it cut the average standalone drug plan premium by about $16 a month. The base premium everyone starts from rises from $38.99 to $41.33. Medicare expects most plans to rise under $10 a month. Some will rise more. And this is the one you can actually do something about. Unlike Part B, your drug plan is a choice. Every single year, the premium changes, the deductible changes, and the list of covered drugs changes. 7 in 10 people never compare. They simply let it renew. So the plan that was cheapest for you last year can quietly become one of the most expensive, and nothing will tell you. The third one is the quietest of all. Your Social Security benefits can be taxed. The income lines that decide it are $25,000 if you are single and $32,000 if you are married filing jointly. Those numbers were written in 1984, and unlike almost every other figure in the tax code, they were never adjusted for inflation. Not once in over 40 years. Here is what that means for your raise. Every cost of living increase pushes your income a little closer to those frozen lines, and eventually across them. So the raise designed to protect you from inflation can be the very thing that makes more of your benefit taxable. Nothing changed in the law. The line simply stayed still while your income moved. Quick break. If any of this raises a question about your own situation, leave it in the comments and check the pinned comment below where I put the links for this episode. Now back to it. The fourth one affects fewer people, but it is expensive. If your income crosses $109,000 single or $218,000 married, Medicare adds a surcharge to both your Part B and your drug premiums. It runs from about $1,148 a year up to nearly $7,000. And it is decided by the tax return you filed 2 years ago, so it can arrive long after your income has already dropped. The trap inside it catches careful people. A one-time event can trigger it. A required withdrawal from your retirement account, a Roth conversion, selling a house. Each one lands on your return as income, and 2 years later, the surcharge appears. And here is what most people get wrong. Those 3 cannot be appealed. Social Security only accepts life events that happen to you, not financial decisions you chose to make. So let us put all four together. For the average retiree, a $75 raise becomes about $68 after Part B. Your drug plan then takes whatever it takes, depending on the plan you happen to be in. Taxes may claim a share above those 1984 lines. And for higher incomes, the surcharge sits on top of all of it. None of this is hidden. It is simply spread across four systems that never speak to each other. Now here's the part that changes your outcome. Of the four, only one is genuinely under your control, and it happens to be the one almost nobody uses. Part B is automatic. The tax lines are set by law. The surcharge comes from a return you already filed, but your drug plan is chosen fresh every single year, in a window that opens October 15th and closes December 7th. Miss that window, and you are locked in for the year. 4 things worth doing before December. Start with the plan finder at Medicare.gov. Enter the drugs you actually take, with the doses, and it will rank every plan in your area by what you would pay for the whole year, not just the monthly premium. That yearly total is the number that matters, because a cheap premium attached to the wrong drug list can cost you hundreds more. It takes about 15 minutes, once a year. Then check the premium itself. Look at what Medicare is deducting from your deposit. If it is more than the standard amount, you are paying the income surcharge. And if a life event lowered your income, Form SSA-44 can remove it and refund what you already paid. Retirement counts. So does losing a spouse, a divorce, or losing a pension. There is one lever that works directly against those tax lines, and most people have never heard of it. If you already give to a church or a charity, you can send the money straight from your IRA to that charity. It is called a qualified charitable distribution. It counts towards your required withdrawal, and it never touches your taxable income at all. So it satisfies the IRS without pushing you closer to those frozen thresholds. The lever most people miss. And one practical detail nobody explains. The new amount does not arrive on January 1st. Social Security pays on a schedule based on your date of birth. If you were born between the 1st and the 10th, you are paid on the 2nd Wednesday. Between the 11th and the 20th, the 3rd Wednesday. After the 20th, the 4th Wednesday. So your first raised payment lands in the 2nd week of January, not on New Year Day. One more thing worth knowing. If you are 73 or older, your required withdrawal feeds directly into all of this. It raises your income, which can push you over the tax lines, and 2 years later, trigger the surcharge. Miss the withdrawal entirely, and the penalty is 25% of what you skipped. Ask your brokerage to calculate and automate it. That one call removes the biggest penalty in the tax code. So, to sum it up, your raise is projected at 3.6%, about $75 a month, confirmed October 14th. Part B takes about $6.60 automatically. Your drug plan takes more, unless you shop it. And the 1984 tax lines keep pulling more of your benefit into taxable territory. So here is your one action step. Between October 15th and December 7th, run your drugs through the plan finder at Medicare.gov. It is the only one of the 4 you control. This is general information, not tax advice. And if you want to go deeper on that 25% penalty, I made a full video on exactly that, and you can watch it right here. Subscribe to the Daily Brief, where we explain your money in plain English every single day.